This week, the U.S. Labor Department releases its May non-farm payroll report. I'd like to make two observations about the report. The first thing is that the report is coming out on Thursday. Normally it comes out on the first Friday of the month, but this Friday is the July 4th Independence Day holiday, so it's coming out on a Thursday. The other observation I'd like to make is that normally equity markets, or at least for the last year or two, have preferred it if the payroll report showed job creation a little bit slower than expectations. Now, why is that? Well, the equity market really likes it when the Fed is cutting interest rates. They love rate cuts. It makes stocks look relatively more attractive. And the Federal Reserve has a dual mandate. It tries to keep inflation under control, and it tries to keep the employment up. And so if the job market is doing a little less well than expected, that increases the chance that rate cuts will come sooner, or there'll be more rate cuts, and that's generally positive for the equity market. So what's unusual about this upcoming number is I think the market wants to actually see a number that's stronger than expected, and let me explain to you why. I think investors have already pretty much decided that the Fed is not going to cut rates in July. I mean, you can't say positively it won't. If actually that non-farm payroll number was terrible, you would start getting big expectations for a July rate cut. But of course, if the non-farm payroll number is terrible, that also may be bad for the equity market. So let's just go on and say, even if you'd had a slightly weaker than expected non-farm payroll number, I don't think that's going to budge the percentages, budge the odds of the Fed cutting interest rates in July, and that won't do anything for the equity market. On the other hand, the market already firmly thinks the Fed will cut at the following meeting in September, but September is way in the future. So having a slightly stronger May number isn't really going to influence things in September. And in fact, I think it'll be reassuring to the market, because I think there's people in the market that are worried that the Fed is keeping interest rates too high. They're running too tight a monetary policy, and that's going to really hurt the U.S. economy. So if you get a stronger than expected number, well, that's sort of like saying, okay, the Fed is doing the right thing. There's not making a mistake by delaying until September. So what is the number that's actually expected? Well, what we're expecting to see is 110,000 jobs created during the month of May, which is a decline from 130,000 in April, which reflects a slowing U.S. economy. Okay. Last week, I spent a bit of time talking about the PCE inflation report, and I kind of pointed out that if we had a good PCE number, that would be further evidence that the Fed could cut interest rates, because if you already looked at the CPI number, the three-month annualized monthly changes was well below, for core CPI, was well below the Fed's 2% target. Well, the PCE number actually came out a little bit warmer than expected. On a month-to-month basis, the core was up 0.2% instead of the 0.1% expected. But nevertheless, core CPI over the last 3 months annualized is still below the Fed's 2% target. And so even though we had that number was a slight miss, we've actually had rate cut expectations increase. So even though at the Fed's last meeting, the meeting that they just had in May, their dot plots where they kind of show their plans for the year sort of indicated only 2 rate cuts for the rest of the year. The market right now, after those inflation data have been released, are expecting 3 rate cuts. So now let's bring that back to the equity market. I think that increasing expectation for rate cuts is part of the reason why the equity market today is at an all-time high. We're up about 1.5% since I spoke to you last week. Another reason that equity markets have been doing pretty well is expectations for second quarter earnings from S&P 500 companies. Until about 2 weeks ago, you had seen analysts consistently lowering their estimates for what U.S. companies, what their earnings were going to be. And a lot of times the factor that they were mentioning was the impact on tariffs. Recently, over the last 2 weeks, earnings estimates actually been creeping back up. So we're back to FactSet predicting that year-on-year S&P earnings for the second quarter are going to be 5%. Now, most of the time, when companies actually report, they beat earnings estimates, so it's very reasonable to expect a beat. Lately, they've been beating them by quite a bit. So that means, although we won't have double-digit earnings growth for the second quarter as we had for the fourth quarter of last year or the first quarter of this year, 7-8% year-on-year earnings growth seems fairly likely, which is pretty solid, good earnings growth for stocks. And also that change of trend from the analysts lowering their estimates to raising their estimates, I think that's also pushed up the stock market. So that's another reason why we're at an all-time high. I'm going to add a third reason, which is a little bit controversial, which is that Trump's big, beautiful budget seems to be getting its way through Congress. Most of the things that you read about that budget are pretty negative, and I'm not going to try to litigate right here whether it's good or bad. But I think the equity market is just glad that the uncertainty is going to be or is being removed, and we're actually going to have a budget passed, and the market can just start dealing with reality and go up rather than wondering what sort of bill that's actually going to happen. Sort of to finish up on my point, finish up on what I wanted to say this week, it's been a very good week for all investors. If you're a gold bug, the market's up a little bit over the last week. If you're heavily into bonds, bond yields dropped, bonds went up in price. If you had credit risk, credit spreads have been stable. And of course, the equity market over the last week's up about 1.5% to a record high, or we hit the record high on Monday, and we pulled back a tiny little bit on the S&P last night. So everything seems to be pretty good, except for we have more information coming down the pike, which could send the market for a loop. And of course, equity valuations, now we are at an all-time high, look a little bit expensive, which should always make an investor wary, although everyone should remember, if it was as easy as you sell your stocks when PEs are very high and things look expensive, and you buy them when PEs are very low and stocks look cheap, you don't outperform the market. Thanks. Goodbye.